Since March of 2023, which is approximately a year ago, the funds that sit in the repo market has been drained from over $2 trillion down to $460 billion. I'm sure you've heard that once or twice over the past, let's say 2 months. It probably leaves a lot of you stumped, asking, what's the importance to me? Why does it matter to me? In this video, we're going to break down what the repo market is, why it's been drained, and why it actually matters to you. Now, the repo market and reverse repo market can be somewhat complicated, so I'm going to do my best to break it down as simple as I can. Let's jump right into it. Now, repo is just short for repurchase, and you could think of it as a short-term, overnight, collateralized interest-bearing loan. And you have very specific players that dabble in the repo market or repurchase market. And that's hedge funds, money market funds, commercial banks, asset managers, and the Federal Reserve. So the repo market is a pretty decent size in that there are $2 to $4 trillion being traded overnight every single day between those large institutions I previously mentioned. And the only collateral, because I did mention it was collateralized, the only collateral that is used in the repo market are US Treasuries. And I feel like that's kind of obvious. You got super low default risk on that, and it's in a higher tier in terms of ideal collateral. As we know, banks are required to hold a certain amount of reserves on their balance sheet to basically buffer against downside risk or insolvency risk. The capital or liquidity that sits in the repo market are excess reserves. And so that allows institutions to either put excess capital to use that would otherwise generate no yield for them. The flip side, if they have a ton of collateral, they get to put that collateral to work and earn yield on that. Which brings me to my next point. You have two sides of the coin here. You have repurchase agreements, and then you have reverse repurchase agreements. Here's a very simple way to look at that. In a normal repurchase agreement, party A sells securities to manage short-term liquidity. In a reverse repurchase agreement, party B effectively buys the securities, which gives party A the liquidity, but it also gives the opportunity for B to earn yield on the collateral that they've just been sitting on. And the yield that they generate in the repo market usually follows the benchmark, which is the federal funds rate. And it's generally a half a point or so higher than the federal funds rate. So for example, if the federal funds rate is at 5 or that lower bound of the effective funds rate is at 5%, the overnight repo rate should be somewhere around 5.5%. So for one more simple example, let's say you need to borrow some cash because you have bills due tomorrow, for example, right? And you come to me and you say, hey bro, I need 100 million. And I said, damn, okay, but can you pay me back tomorrow? And I charge you 0.5% above the benchmark. For easy numbers, let's just say 1%. And I effectively buy the collateral that you have. In turn, you receive the liquidity, you get your bills handled tomorrow. At the end of the day, when your check clears, you send 100.1 million back. Now, where does the Fed come in? I'm sure you guys have heard this before as well. In 2019, with the repo market blowing up, the overnight lending rate in the repo market shot up to about 10%, which is completely unusual. And so that effectively created a supply and demand imbalance, and lenders were refusing to lend. And so the Federal Reserve had to step in and start buying treasuries from banks to shore up liquidity, which is part of the reason now the Federal Reserve has so many treasuries on their balance sheet currently. Once again, it's the same idea for the Fed. If they run repurchase operations, they're effectively buying treasuries from banks. In a reverse repurchase operation, they're selling treasuries to banks, taking liquidity out of the system. In the former, putting liquidity into the system. So while it's not necessarily QE, or quantitative easing, it still is a form of quantitative easing as you're injecting liquidity into the system if you're running repo operations. And this is just one of the ways the Federal Reserve is able to manipulate the money supply, i.e. liquidity in the system. Because once again, if the Fed is buying treasuries from institutions or banks, they're effectively giving these banks liquidity overnight. And if they decide to sell treasuries to these banks, they're removing liquidity from the economy. Now, why is that important to you? Or why is the repo facility or repurchase facility important to you? Well, the repo rate, or the overnight lending rate at which these institutions use within the repo market, that actually trickles down to the rest of the economy. What I mean is, if the overnight rate went up, what that does is make everything that the bank does in terms of consumer loans more expensive. And so auto loans would be more expensive. The interest rate on mortgages will be more expensive. Credit card rates will go up. Lines of credit will be more expensive. HELOCs on your home will be more expensive. You guys get the point. It trickles down to pretty much everything. And so it's always important to keep that overnight lending rate somewhat stable above that benchmark, which is the Fed funds rate. Now, over the past year and a half, 2 years or so, the Treasury General Account, or TGA, has been drained. Now, that's due to fiscal policy in a myriad of ways, including stimulus, and the Federal Reserve is refilling that account using the repo market, which is part of the reason the funds that has been sitting in the repo market has been drained from 2 trillion down to about 460 billion. Now, they're not going to let the repo market get to zero. The excess reserves that sit in there, they're not going to let it get to zero. And so we should expect the Fed to buy more bonds or treasury securities, which kind of goes back to the meeting the other day that he had, the FOMC meeting, saying that they would like to have a balance sheet made up of mostly treasuries. Part of that will be refilling the repo market. It's kind of like the plumbing of our financial system. So yeah, all in all, guys, you could look at the repo or reverse repo market as a tool for the Fed to manipulate money supply, control the lower and upper bound of interest rates, and a lifeline for banks, and a yield-bearing mechanism for money market funds, hedge funds, and other dealers. So as you start to hear more about the repo market going into the future, hopefully this video provided some type of foundation for you to understand what is actually happening and how whatever move is being made at that time, how it's going to affect you, and if it's going to affect you. As always, guys, I hope you got a ton of value from this video, a little more educational. If you do enjoy that, let me know in the comments, leave a like, make sure you subscribe. Feel free to book a free strategy session down below, link in bio. And guys, as always, see you on the next one.